In this video, we're going to be using Excel to determine the effective interest rate of a lease when the fair value of the asset is known. This will be useful for accounting for the lessee, the person who is leasing the asset. The lessor, of course, will know the implicit amount of the interest rate that went into building the lease agreement. So we're going to set up our Excel spreadsheet, similar to what you see on the screen. We're going to be using the Excel function for rate that is contained in the financial folder under formulas. So we want to set up our screen so we have a row that signifies N, and N stands for the number of payments that are made over the life of the lease. We will have another row for PNT, which should always be entered as a negative number to designate a cash outflow, and that will signify the lease payment. We need to know the fair value of the leased asset, so this will be either a level 1 or level 2 fair valuation. We cannot use this worksheet to determine the interest rate if fair value is not known, and we're doing a level 3, which is a discounted cash flow. In that situation, we have to establish what the interest rate is and then solve for the fair value. Next, we're going to say whether this is an ordinary annuity, payments made at the end of the lease period or at the beginning of the lease period. And then our rate will be what we're solving for, and we're going to use the Excel formula for the rate. So we're going to use the information that's contained in the illustration on page 817 in chapter 15, and that's illustration 15-2. The problem tells us that we're going to have 6 lease payments, and each lease payment is going to be $100,000, so we're going to put that in as a negative $100,000. The fair value of the leased equipment is given at $479,079. The payments will be made at the inception of the lease on day 1 of the lease. So we have an annuity due. So we're going to place a 1 in the type, and then we're going to go up to financial, choose the function for rate, and then we'll input our data. We have the number of payments, the payment amount, the present value, and the type. We simply hit OK, and it will return a rate of 10%. We would then use this 10% to construct our amortization table. So again, the lessor would have to go through this exercise to determine the amount of interest expense and the reduction in lease payable for each payment, and that's going to be part of our account.